How's it going? We are alive. Yes, it's a good thing I'm alive. This is 0 days to expiration. This is the final hour trade, and this is the second half of our journey to 100 trades going live. We gotta shut her up. Gotta shut her up. Let's see. How can we shut her up? Let's do this. There we go. Shut up. So we did 50 attempted trades up to this point, trading the very final hour using our 0-DTE strategy. The results were pretty good. We had 10 trades or 10 instances where we did not take a trade. So there were actually only 40 trades. But we averaged a 60% win rate, and it was 24 wins, 16 losses. And our returns ranged anywhere from 50 to 800%. So all in all, I would say that was a pretty good record. The second half wasn't as good as the first half. It's the way it goes. So in other words, the first 25 trades were way better than the second 25 trades. So we're starting brand new, and we're going to be adding the E-mini futures as a potential trading vehicle. Before we were just doing SPX. And the reason for doing that is so that we can show that you can also do this with very small accounts, because you simply cannot use the SPX 5 days a week, because you would be tagged with a small account. You'd be tagged a pattern day trader. And you don't want to do that, because if you do, they will shut down your account for 90 days. All right, we just got off of a trade. Well, actually, a lot of people in the group may still be in the trade. And it was pretty good. It was a 1-to-7 risk to reward ratio. Most of the people got in probably around, anywhere from $1 to $3. And they're probably getting out now anywhere from $5 to $10 or more. So all in all, anything from, say, a 50 to 500 or more % return on capital. And there's still people there. I'm sure they're managing their trades. I had to get out early, so I left a lot of money on the table, still made a lot of money. When you're managing a live stream and talking to people and trying to support 600 plus traders at the same time, it's a little bit difficult to manage your trade. So I just got out, took what I had, and then that was fine for me. Sacrificing myself for everybody else. All right, what is it that we do here? We trade options on the very final day of expiration on the S&P. We trade two different assets, two different derivatives of the S&P. Options on the E-mini futures. That's the ES for most people. And options on the index, the SPX. And so they both have expirations that expire Monday, Tuesday, Wednesday, Thursday, and Friday. Tuesday and Thursday are fairly new additions to this lineup. They just added those two expirations in May, late May. And for the longest time, it was just Monday, Wednesday, and Friday. I like Monday, Wednesday, and Friday, because then you have Tuesday and Thursday off, and you don't have to have this, like your head is in the sand 5 days a week. I like that cadence of having a day off. But I traded today, and the trading on these is really, really good. The liquidity is fantastic. Very small spreads. You can get in, you can get out. You might have to change and replace a couple of times, 1 or 2 strikes to get your price. Sometimes things can get fast moving. The gamma risk near the end of the day starts to increase because of the type of trades that we do. We do butterflies. And so as that profit curve is filling up the butterfly, that triangle, you get this profit curve that's like this, and that creates high gamma risk. Gamma risk being the rate of change in price by the change in delta. So in other words, if price is moving this way or that way, right, and it's sitting on a curve like this, right, imagine that. So prices, your value is going up, way down, very fast. A lot of things that you can do to help that out is, one, just try not to take it right to the very end, get out a little bit earlier and sacrifice maybe that last couple $100 and just get out. That would be one possible solution. The other is in general, you could try to put on much wider strategies so that the gamma risk is reduced somewhat by the width of your trade. So if you have a much wider butterfly, then the gamma risk is going to be less because the curve is not going to be as like this. If you have a very narrow 5 or a 10 wide fly, then your gamma risk is going to be really high because the profit curve has to go up and down like this. But if you have a 20 or 25 wide fly, it's going to be much easier to manage your trade as you go deeper into the expiration. And that's ultimately what we want to do. We want to go as deep as we can into that expiration so that we can get as much of that premium decay as we possibly can. Of course, you're fighting against time. Things start getting a little volatile. So you have to make a choice. And it's all sacrifice on which way to go. Of course, every once in a while, like today, right now, we're sitting right at the pin or the apex or the short strikes of our butterfly. If the market were to close right now, we would be at max profit. But if you get out right now with only 37 minutes to go, you're going to get about 80% of that max profit. And that's pretty good. When you consider that most people are putting on 20 wide spreads, so that'd be $2,000 max profit minus the debit, which was about $200, potentially $1,800 potential profit, and then maybe 80% of that. And so you're really talking about, I don't know, $1,500 that you could get right now, just getting out with plenty of time left in the market. Or you could hold on and see if you can make that last $300 or $400. That's completely up to you. But I like the sound of easy money, and you got it in hand. Why risk it? So we got some people online. Hey, where is everybody, by the way? Are you there? Are you watching this thing? They're probably all managing their trades right now, so I don't blame them for not getting onto the stream. But if you are out there, say hello. How you doing? We got Craig here and Les and Mohammed. How you doing? Glad you all could show up. I know that there's plenty more of you out there. Yep. There's Dan. We've got everyone's going to show up now. There we are. They're all there. A1, how you doing? This is here. All right. Peripatetic. I don't know what that means. And Sasha and Donald. All right. Look, everybody's showing up now. Alan, how you doing? All right. So we're going to try to bring this into the end of the day. Now here's the big question. Where is it going? Are we going to have a continuation move through, or are we going to maybe retrace some of this move? All right, we got a question here. How did you come up with the one trade probability of 75% and one trade? Oh, he's talking about an example that I gave in the Discord. How did I come up with it? I was using it as an illustrative type of thing. If you had a choice between two trades, one where you had a 75, 80% probability of profiting, price was already sitting right there. You could put on a nice little credit spread and ride it out, and probably a really good chance that you would profit. And you would probably make maybe, let's say, maybe a couple $100. Sounds like easy money, right? But the risk is pretty high. So if you happen to run out of there, you would suffer a pretty big loss, maybe $1,000 or so. Or would you take the trade that's sitting way out of the money? It's only a 35% chance of actually making anything. Your risk is super small though, like $150. But if you fall into it, you make $2,000. Which would you choose? Would you take the easy money, the $200, with the risk of losing $1,000, or would you go for the much lower probability trade where your risk is minimal, but the reward is huge? Now, I would take the long shot every day of the week. Every day of the week. The long shot, the asymmetric trade, by far, if you take that trade day in, day out, will absolutely blow up your account. In other words, you'll gain, and you'll have a much better positive expectancy than the high probability trade. It's just no contest. However, what most people would do is they would go for the high probability trade. And that is because that's what they're conditioned to do. They think that putting on the high probability trade is the way you make money. And I'm telling you, the high probability trade is the way that you lose money. The low probability trade maintaining and containing your risk is by far a much better way to go. And that's basically what we do here at Zero-DTE. Now, all the other Zero-DTE services, they do the high probability way. We've got plenty of those people from those services that have come here telling of the woes that they have there. They're not making any money. They're going through complete anxiety all the time. They have one loss that wipes out multiple weeks of profits. Those type of things never happen here. A quick explanation of the Batman trade in any situation where it makes sense in the final hour. It might make some sense, but I don't particularly like the Batman trade. The Batman trade basically is where you're putting on two symmetrical butterflies and flanking them on either side of the current price at the money. And the idea is that you're going to move one way or the other. Maybe you stay right in the middle and then you lose on both. But if price moves one way or the other, then you're going to profit. The problem is that you're doubling your risk. You're doubling your risk and you're halving your profit. And that's a problem. As opposed to just taking the asymmetric chance of getting one or the other. That's really what we're here for. I mean, what I just went through, this whole idea of taking asymmetric trades, small risk to large potential profit, has a positive expectancy. You do not have that when you start diminishing it. As a matter of fact, I would like to go the other way. Instead of putting on Batman trade, I would put on trades that have even lesser probability of winning with even less cost. But there's a minimal amount of cost that you can incur. And that's because the commissions on the trades, so there's only so little that you can create the risk. And there is some level of expectation. How far out of the money can you place something and truly expect to be a winner? Once you go too far out, then you might as well just not play. So there's some acceptable limit, but trying to get really closer, trying to stack up these trades so that you can always be a winner, that's really antithetical to everything that we're talking about here. Can I talk about the hanging trades for overnight? We will be doing some of those as well. Now, what they're referring to, hanging trades. And in essence, every trade that we do is what I would consider a hanging trade. But for most people, a hanging trade is one where you put a trade that's way out of the money and it's there just in case there's an overnight move or some surprise move. And your technical analysis probably would never pick this up. It would seem like a mini black swan event. But when you do hit it and it does trigger and you do get into the trade, usually those trades, first of all, cost practically nothing to get into. And the returns are spectacular compared to the risk that you take. So those are trades that we would, quite frankly, every day that we put a trade on is, in essence, at least from most traders' perspective, are hanging trades. They're wondering, well, how in the world could you possibly put that trade on? So here's an example. I'll show you today's trade, for instance. Here's today's trade. The blue box represents the spread that we put on. All right, so that's a butterfly spread. It was centered on 38.20 and it's 20 wide. We put it on when price was way up here somewhere, right? Way up here somewhere. And so consequently, the trade didn't cost us a lot of money. Some people, I was able to actually get into actually, we put it way over here, somewhere over here. And so price went against us, and I was able to actually add to the trade to reduce my cost basis even more. So now my trade was very cheap, able to reduce my cost basis by more than 60 cents per contract. So what were the odds that we were going to come back down? Some people were thinking, oh, it looks like we're going to break out. As a matter of fact, one of our members said, oh, it looks like we were going to the upside. And I said, I don't know. Looks like a 50-50 proposition to me. And so we basically put on what some would consider a hanging trade, one where it's way out of the money. Odds are like, 1 part risk to 7, 8, 9, 10 times reward. What are the chances that you're going to get that? It's probably about a 30% chance of pinning, a 30% chance of actually just getting into one of the long wings right at the very edge of the trade, right around here. probably about a 10% chance of getting right down to the center strikes right here where you would achieve max profit. Now, what happened? We apparently beat all those odds and we came down and everyone was able to get out of their trade with plenty of time in the market and with returns where they put up maybe a couple $100 and they make $1,000, $2,000, $3,000. All right. So that's basically how our how our service goes. Now, we don't get those all the time because we're hanging trades. In other words, because our risk is so small, we don't have to win very often. When we win big. When we lose really small, really small. So it's not unusual if you had, say, a couple $100,000 that you were trading to not really trade much more than 0.5% per position. And with that, you could produce a very, very nice return over the course of a year. I'm saying with very little risk and very little anxiety, return 20, 30, maybe even 40% on an account that size. And risking very little money, really. And your drawdowns are super small, on the order of 6-7% drawdowns, tops, max drawdowns. Let's see here. We have another question about overnight. Oh, where would you put it? Oh, it's the same question. I didn't read the whole way through. Would you put the overnight trade before market close, before 4 p.m., or right after the market open at 6 p.m.? Generally, what we've done in the past is put them on around 9:30 at night. And that seems to give us our best risk to reward. And at least the Asian market has opened by then, and you can get an idea. If you're overseas and you're up during the European Open, then you can monitor that trade and find out whether or not it's going to be a good risk or not, or maybe even add to the trade. Typically, those trades, we're out of them by the morning. Sometimes we'll hold them right into it. And we've had some trades where we've brought it right to and pinned and made unbelievable profits, sometimes as much as 1,500, 1,800% return on our capital. Yeah, so that's one of the advantages of trading the E-mini futures, that you can trade 23 hours a day. And so the market, the session for the E-mini opens actually 6 o'clock the previous day, 6 o'clock at night the previous day. So like I said, we wait until about 9:30, get a read on the market, and then decide in the market profile or the volume profile and figure out where's the best place to place a trade. And we can typically put something super far out of the money, but also very wide. So we have a very high probability of touch. In other words, there's a good probability that at some point from now until the expiration, that price is going to come inside or touch the profit tent of that strategy. And because we put on such small amounts of risk, usually on the order of 1 to 10 or 1 to 12 or 1 to 15, 1 part risk to, say, 15 parts reward, it doesn't take a lot. Sometimes we don't even have to enter inside the profit tent, and we can still manage to win triple-digit returns, 100, 150, 250%. Now, I'm sure that most people trading spreads would love to be able to do that. Or iron condors, they'll never see that kind of return, ever. The best they'll ever see is maybe 10% of their risk, max. And so when they hear numbers like routinely getting 150, 200%, it just doesn't compute. But that's basically what we're looking at. All right. Yeah, there's a good possibility this trade runs right through our spread, which is all fine. But now we have to figure out, is it going to do that? Or is it going to pin? Oh, man. This is what I think. I think that we're going to come down to 3,800. I think maybe 3,800 is the place to go. I would say 3,800 is probably our mark. Now let's take a look at the options chain. Oh, I have to bring it over there. It's on the wrong monitor. According to the expected move, there's only about 10 points to go. So that kind of points to... I need to see more strikes. Yeah, 3,800 right here. That's going to be tough. What would a butterfly give us right there? Oop, what happened to it? I have to do this again. So our probability of touch at 3,800 is about 50%. That's usually what we like, or 30% is a good number too. So let's try 30%. And if we made our wings 10 wide, then we would be within 75% probability of touch. We're already in profit. So if we move down into the 3,800 region, but let's make them a little wider. Make them 10 wide. See what kind of risk to reward. I don't know. That risk to reward is high for me. I don't like that. Let's take a look at the chart again. Whoop, everything went black. Let's back up a little bit, see what we're dealing with. So this is the spread that we put on this cyan box today. The right-hand side is the end of the market. The left-hand side is where we entered the trade. The top and bottom is the width of the butterfly, centered on 39.20, which is right there. And we went through it. Here's an LVN right here. It's probably, looks like it's going to come down here, possibly either bounce or move through to the next value node, which is T0B. Going through, these are child nodes from T0A to T0B. Question, is it going to do it right now in the next 20 minutes? Highly unlikely. I'm going to guess and say that maybe we'll just pull back a little bit and then come back up to T0A, and we'll call this a rejection and come right back up here. So that's what I'm going to choose. I'm going to say that 38.20, which was our original trade today, is probably the best trade to do, and we'll probably get some good pricing on it. Let's try that. All right. 15 wide is a little much. Let's go for 10 wide. Man, it is hard to get a good risk to reward here. $2 on the ES, that's really much less than that. That's half of that. So that's about $1. Or in other words, $100 risk to make about $350, $360. Man, I don't like those odds. I really don't. You know, maybe if we push it out some, maybe we can get a last minute move. That's the thing. Is the move more likely to go up or down today? That's a hard one to tell. Let's zoom into a 3-minute chart and look at this sucker. It's accelerating right into the end here. We have a little bit of resistance or support as we came into this LVN at 3,800. I think that we're going to move right through it. I think that's what's going to happen. And then overnight, we're going to continue to move through it. So maybe 3,800 is the way to go, and maybe make it super narrow. So let's try that. Yeah, I don't know. The pricing just is horrible. All of this, I'm going to pass. That's my best judgment. We just can't get good pricing here. So I am going to pass on this one. That's a little bit of a disappointment, but normally we can get much better risk to reward. But right now, that's simply not happening. The best it looks like we can get is 1 to 3, and we're usually looking for 1 to 10. Without those type of numbers, are just not worth it for us to trade. Right click it and then create a closing order. Why would I want to do that? Oh, you're talking to somebody else. Yeah, $100 to make $350. I don't like those odds at all. So the more interesting thing for us right now is, will this return to 38.20 and then pin our trade for the day? So that's this trade that we're currently in. I've already exited the trade, by the way. I think I told you that. I had to exit because, well, I'm doing the live stream. I'm supporting a bunch of people. I can't do all of that at once. Yeah, maybe as I had said earlier, the move was to go back up into T0A, this volume node, because we are doing kind of a retracement here. Right. Perry Paddock says, I can't close the trade. Make sure you're using 25-cent increments. Little misspelling there, but hopefully that will help. But typically when you have a return that's over $5, yeah, streams, I already looked at 3,800. I mean, maybe now that it's moved away from it, but we've only got, there's still plenty of time. Yeah, but see, even here, man, the risk to reward is horrible. It's getting better, but it's still horrible. What happens if I go 5 wide? I know that normally we're like, oh, 5 wide, Ernie. What the hell are you doing? But can we get, now see, there's the kind of risk to reward that I like. Yeah, I'll do that. I'll do that. I'll take this trade. Let's see if it got, there we go. I will definitely take that trade. So here's the trade that I just took. What was it? 45 cents or $22? So let's see what happens. Yeah, I'll take that trade. What the hell? I just made about $2,000 on my other trade, so I can afford $45. Let's see if it will move down. I just want it to be known that Shreem pushed me into this trade. So if I lose, it's all his fault. All right, I'm glad that Peripatetic was able to get out. It looks like putting the limit order on 25-cent increments allowed him to get out. Once you get over $5 of return, especially if you're in Thinkorswim, I don't know about the other platforms, but you have to put your limit price in 25-cent increments. Otherwise, it won't get you out. When you're under that, you can go 5-cent increments. No problem. Always glad to help. So I don't know. I don't know if my trade's going to work out or not. It doesn't matter. We had such a great day today. It was a lot of fun. I also did another podcast earlier today. You might want to check that out, where I talk about the value of asymmetry and really why so many traders are fooling themselves thinking that they might have a chance at sustained returns of 30, 50, or 100% or more every year. And when the vast majority of people don't make a dollar. And when I say the vast majority, like over 90% of most people never make a profit. And you think you're going to have sustained profits of 30, 40, 50% a year? It's crazy. If you did, you would be in the elite of elite traders. And people would be banging your door down, wanting you to trade for them. Trust me on that. That's the way it would be. And that is all because people are predisposed to want to use high probability trading setups. It's kind of like a siren. The story of, who is that the story of in the Bible, and the sirens? Is that Hercules? I can't remember. But the sirens, they lure the travelers or the sailors into their island, and then they eat them. I know, crazy. We're all attracted to shiny objects, things that may look intuitively great, but they aren't. High probability strategies simply do not have a long-term positive expectancy. Oh, Ulysses, yes. Thank you. I should know that. I'm Greek, right? The hell you doing, Ernie? No, you're Greek mythology. All right, so 8 minutes. Oh, that's right. It's from the Odyssey. You're right. See, what the hell am I talking about? I am one pathetic individual here. All right, let's check this trade again, see if we're making any headway here. We got to get moving. It's got to move really quick. No, I don't think it's gonna. Look, it did this retrace. It's going to go all the way down there again. It'll probably do it after the market closes. The idea for this trade, by the way, it's not that we're sitting here doing all kinds of technical analysis of where we think price is going to go. We're basically putting our strategy somewhere in the vicinity, hopefully backstopped by some sort of market structure, whether it's a value node or an LVN and see if price will come down and come into our parlor, so to speak. Oh, this is a problem. Muhammad says, I can see you're tired from all the excitement. Do I look tired? Maybe I have to change the lighting here. It's probably the beard. I have not shaven for a while. Oh, is betting on 3830. We're all rooting for you. It doesn't look like my 3800 is going to work out. It's got to drop dramatically in just a few minutes. Oh, Les is saying it's Jason and the Argonauts. Is that who encountered the siren? Everybody has a different version. We'll have to do a Google search. Dr. Russell says, if you were still in the 3820 trade, when would you exit? How would you manage into the close? I talked about that earlier. I said that if you were, and this was our first pass by 3820, I said if you had multiple contracts, then I would take enough off to guarantee a profit. So let's say you had 4 positions on, 4 flies. I would take 3 of them off, let the other one ride. So if you only have 2, then take at least one of them off and let it ride. Anything that would guarantee you and of course, anything really, you could probably take off 1 out of 3 and still guarantee you a profit. But I would take the majority off to guarantee a good profit. And then see if that last one will pin. Or you can do what I did, where I really didn't have the time to manage and just take it all off and be happy with the 400, 500, 600% that you just made. But generally, that's what we do, Dr. Russell, is we, when we're in that position where we can potentially see a pin trade, but we don't want to lose out because of the gamma risk, just take off the majority of your positions and then let the last one ride so that you guarantee yourself a good return. All right, so Aaron says it's the Odyssey. How did you get to node at 3820? It doesn't look like there is much volume there. Well, volume isn't necessarily the final arbiter as to whether or not that's where price is going to end up at the end of the day. Because remember that the market is alive more than it is just when the cash market is open. It's alive 23 hours a day. So it's not necessarily where price is going to go. What we look for are, and there, by the way, at that particular point, there was a small child node that we call T0A, and banking on price coming down and touching the bottom of it. So that's how I chose it. Plus, that in combination with being so much out of the money so I can get a good risk to reward. You weigh those two things. You can't be totally precise. And it doesn't matter if you are totally precise because you can't. No one knows where the market's actually going to go. But using some of those features in the profile that would more or less slow price down as it went through there gives you the opportunity to then take profits a little bit more readily. So that's generally the thinking. All right, here's another question from Dr. Russell. When you say let it ride, would you close at last minute or take assignment and close the futures contract? I would close before it gets assigned, unless you know what you're doing. Now, I happen to know what I'm doing, and it would depend on other positions I might have. Now, let's assume that you don't have any other positions and you just don't want to trade the futures contract, then you want to get out. If you want to maximize, you see that you're going to absolutely maximize your profit by staying in that last couple of minutes is going to give you maybe an extra $200, $300, $400, then it might be worth it to go into expiration. Now, keep in mind, you could easily lose that $200, $300, $400 in the matter of just a few seconds once that futures contract appears in your account. And if price is moving fast and you're not able to get out of it quick enough, you could potentially lose a lot. You could also potentially gain a lot. There's been times when I've let the futures contracts get assigned to me and I make a few extra $100 because when it came in, price moved in my favor and made some money. But in general, you don't want to take that risk at all. You just worked all day to try to get the profit from the options contract. Just get out a few minutes before the market closes. Make sure you have plenty of time to do it and that your skills are up to the task. because quite frankly, price is going to be moving a little bit right there at the end, usually is. So as far as letting it ride, it's a very, very personal choice and depends on your situation. If you have a small account, you want to get out. End of story. There's the market. All right, so our little trade didn't work. We're starting off this last 50 on a bad note, but a fantastic note for the day. Oh, look at that. We pinned. I can't believe we pinned. We pinned the trade today. Wow. Just wow. The futures market hours. The futures, the session opens at 6 o'clock at night and closes 5 o'clock at night the next day. The trial service includes everything. The trial service includes everything. So when I say everything, including coaching and mentoring, my personal mobile number, etc. So you're just like a full-time member. And the reason why we have a 4-week trial is because there's a lot to learn here. This is not just an alert service. As a matter of fact, it's not an alert service. We issue alerts and I share all of my trades. I'm completely transparent about everything that I do. Everything is shown right up front. But this is really about learning the strategy, the methods, and the process that we do. So, all right. Aaron is agreeing with Sasha. My question's too at Aaron. I don't know. Are they having a conversation back and forth? I'm not in it. But anyways, the center strike that we chose today was right at 38.20. So what that means is that most people will have pinned their trade and made massive amounts of money. In this case, probably around 600 to 800% return. That's what happened just now. You just saw it. You just saw where our strategy was. How I got to the center of the butterfly how I chose 38.20, I guess is the question. Does options on futures close at 4 p.m.? Yes, they do. They close at 4 p.m. All right, so how I came to 38.20, you'll notice that there's a box or a band going through from 38.22 all the way, well, let's see, where is it? It goes from about 38.22 all the way up to 38.34. That band is part of our analysis that I do at the beginning of the week that outlines volume nodes, right? So there is what you would call a child node. It's not a major node, but it's one of the smaller nodes, and it was developed by more recent activity. And so the idea was that I felt price was going to go down. You'll see these arrows here. Those were my scenarios, my two scenarios for the day. That's where I felt price was going to go. I thought it was going to go up, then down, so there are two cases. One was the bullish case was go up and then down. Went up a lot higher than I had thought. And then the other one was just go down. But both of them would have resulted in down. So now I have to decide where to put something to match up that analysis. And so I'm looking for features in the market structure where I think price would find some support or gravitas or just slow it down somewhat enough for us to have a fairly high degree of confidence that if price came down there, it would be easy to get in and out. That's basically it. The other part, the vast majority of our placement, though, has to do with trying to get the best risk to reward. So we're placing strategies, symmetrical butterflies, so that we can get the best possible entry or the debit to that butterfly relative to the maximum profit. So that is that's everything that this strategy is about. And this methodology is getting that asymmetric trade on there, because we know that if we put on these asymmetric trades even if we're somewhat close, it doesn't matter. The law of probabilities will dictate that we're going to hit so many pin trades, so many right at the edges, some out of the money that are still profitable, etc. There's some level of return that we're going to get. But as long as we have that asymmetric and we have that small risk, and our risk is well defined, and our upside is much greater than our risk, then we're going to, in the long term, have a positive expectancy. All right. Another question. What is the time frame in this volume profile? Is it different from one we were looking at before? The time frame is, I start with looking at about 20 months worth of data. It depends on what the past is, right? So if we were at the top of the market, I'd probably only be looking at maybe 4 or 5 months of data tops. But where we're at right now, there isn't a lot of recent data because we're coming down off of a high. So I have to go all the way back to what the last period of time was that had actual volume so that I can see the profiles from the past there. They still have relevance today. And then from that, I will build the profile. I think I did a live show on this yesterday morning. So if you go back to my YouTube videos for yesterday morning, you'll see where I actually created the weekly market structure. And so you'll see very clearly that this, how I created these. And some of them I added since then. So we've updated it a little bit, and it gets updated throughout the week. And then every week we redo it. All right, let's go back to the big head. All right, so there you go. I shouldn't have taken the trade. He forced me to do it. So it's all on him. I'm going to be sending him a bill. But that's our first trade. Ultimately, I wouldn't have taken the trade, but I felt pretty good about taking it only because it was basically a pin trade. I made a lot of money today. It looks like members of the service made way more than I did because I got out early so that I could manage the stream. All right. And we'll be back here tomorrow doing it again. We're going to do this 50 times. What we're really trying to do is gather information about trading that final hour. Are there things that we're going to notice after analyzing all that data about the returns that we got that might help us in perhaps even creating another strategy trading near the end of the day? I don't know. Maybe I'm taking it a little bit lightly. I'll try to be a little bit more focused on that stuff, but that's basically it. And it's also so that other people can see what we're doing and to give a report of how our trading day went as well. So it has a multi-prong purpose. So anyways, that's it. I want to thank you very much for showing up. We'll be back here tomorrow night. Peace to you all. Take care.